And so while we'd sit here and tell you, don't plan around tax benefits, but if you're close, like if you're a couple $100 away, $1,000 away, maybe give a little extra to charity, or I don't know, itemize something to try to get you under that threshold.
Welcome to the Fiscal Foxhole, the podcast proving you don't need a degree in finance, just some grit, a game plan, and maybe a sense of humor. Your hosts are retired Army veteran Rob Moore and retired Marine veteran Omen Quelvog. Together, they'll help you dodge financial landmines, call in the air support on your savings, and laugh at the ridiculous money mistakes we've all made. If you can survive mandatory fund days, you can survive personal finance. Welcome to the Foxhole.
And welcome back to the Fiscal Foxhole. My name is Rob Moore, and I'm here on duty with you, as always, by my favorite Marine, Omen Quelvog.
What's up, Rob? You always have such a kind intro when you introduce me. I feel like you should be a little more harsh sometimes.
Yeah, I like to backload all the, let's say, the backhanded compliments that I give you throughout the episode. I feel like I have to be nice to you out the gate, and maybe at the end, like sincerity builds that trust. So it can sting even harder when I throw out the insults and the jokes.
Is this like writing fitness reports, like the Velvet Daggers? The language sounds nice, but actually it's terrible. This is how you really think of them.
Yeah, exactly. Fitness needs improvement, right? It's like the kind of way, it's Army's way of saying you're doing a terrible job. But no, I'm sincere. I love seeing you here every week talking about this stuff. We're out of our tax episodes. We're free from that. I think it was good listening back at those 3 episodes. It was really nice. I was able to refer a few people that had questions recently about taxes before the end of the year, like applied. It's like, hey, we've got this episode's coming out. You should have a listen. So it felt good knowing that it was being enjoyed in some way that was useful to some folks. But it is nice to turn the corner and talk about something else. Before we do, I have a mea culpa that I need to offer.
Okay, Let's go.
This is a good learning point for me. You had called out the fact that for some reason I was saying tax lost harvesting last episode. And listening, so that was what? That was 2 episodes ago. And then the last one, you called me out on like, nah, there's no way. I don't think of it that way. I don't hear it that way. And lo and behold, going back, yeah, like 4 times.
Yes. You know what though? You are not the only one. I think it's just the way that it comes off the tongue. Like I've heard many people say tax lost harvesting, and I don't know why it comes out that way. Yeah. It just does.
It's wild. I think there's a Black Mirror episode where the woman's able to change the universe, like with the click of a button on her necklace. And that's what I feel like I was watching. Like, I don't remember saying that, but like, here it is staring me in the face. My own, I don't know, tics, ignorance. I don't know what you can chalk it up to, but you were right. And I will own it. Tax loss harvesting. Anyway,
I appreciate that.
Yeah, that's good. Now you got a good foothold. I like how we kind of compile these things to tease each other about as we go forward. It feels good. The other thing I did want to bring up, did you see the TSP email that was sent out?
I missed this one.
Yeah, you had told me, because you rolled your TSP out, correct? To an IRA?
That's right, yeah.
So,
and that's not recommended to people. Like, you don't have to do that. I'm just saying.
Yeah, you can't.
Yes, I rolled my TSP out.
Yeah, different reasons you can do that. There's reasons to keep money in there. A lot of good reasons to do that. That's another episode. But I did receive an email from the TSP outlining the TSP Roth conversions, which we had just finished talking about. And at that time, we had to speculate, right? Like how it would be treated. It turns out a lot of our assumptions were correct, or at least on the right path, which was nice. 2 things to bring up. The pro rata treatment for the conversions. Yeah, that's what we expected because TSP tends to treat almost everything as a pro rata, and that's how they're going to treat it. And the email, I haven't clicked on all the links. There's a ton of reference links in the email. I haven't had time to go through it, but it did mention specifically in the email that the taxes will need to be paid out of separate accounts. Like you can't pay taxes out of the conversion itself, which is great. I like that they put that in there. There's other things that are hopefully buried in the links, like, the pro rata stuff we talked about and making sure that you're paying on time. But at least that stuff was in there, which was really nice.
Yeah, that is good. I'm glad they mentioned about taxes. I think there are, and I don't know if this email said anything about, contributions from the employer or, on the tax side of things when you go to pay. Oh, did it? What did it say?
Yeah, reading here, I just pulled it up from the email. You can convert contributions and earnings from your traditional TSP balance. When you choose your conversion amount, the money will be taken proportionally, i.e. pro rata, from your eligible contribution sources. And they list here those sources: payroll contributions, agency service matching contributions, if applicable, agency service automatic contributions, if applicable. Of course, those are the BRS, and traditional rollover contributions. That must be talking about if you're rolling money into the TSP.
Yeah, that's what I was thinking.
Yeah, it's interesting. Yep. So
that's really cool.
Yeah, so that's good. I mean, it gives you more options, I think, and it's being applied, I think, in a very fair manner. At least it looks that way at first glance. All right.
Yeah, we'll have to do an episode on this when a little bit further in the future when we get a little bit more details on it.
Okay, good. Oh, actually, yeah, and it did mention it's starting January 1st. Great news. It is starting on TICE at 2026. We didn't expect it to be maybe right away, but yeah, it looks like they're ready to go, locked and loaded 2026, January 1. So yeah, we'll hit this more next year. But in the meantime, we've got some business to take care of for today. On the docket, in the foxhole today, we've got a couple things to talk about. Of course, we have our headlines that we want to talk about. This is a good hammer home point from episode 5. We talked about open enrollment. We've got some stuff to talk about there. And then for the meat of the episode, Omen, we've got our first listener question.
Yes.
Yeah.
I told you this is coming.
Yeah. Omen, you teased about it last week that we had our first listener question. It's really nice that we've got this question coming into us. It's got a lot of meat on the bone for us to talk about. We built the whole episode around this question. It's a really kind of comprehensive, open-ended question, opportunity for a lot of dialogue. So this ain't Dave Ramsey. You're not going to get a quippy, answer. We're not going to, shame you into any financial behaviors, but we're going to talk about the situation. We're going to talk about how it applies to a lot of other folks. The thing I'm looking forward to the most, however, is our off-duty segment today. Omen, this episode's dropping in December 3rd, which means we are in Christmas movie season. So if you are a fan of Christmas movies like Omen and I are, stick around for Off Duty. We're going to break down the official Fiscal Foxhole Top 5 Rob and Omen Christmas movies, including the overrated, which I'm really looking forward to because I think I'm really going to make some people mad. You want to get emails. I think the answer for my overrated Christmas movie is going to get some emails. So prepare yourself for that.
There we go.
Yeah. I can't wait to feel the rage. All right. Well, before we do that, let's go ahead and jump into it, shall we? We'll get in today's headline. Today's headline comes to us from the Federal News Network, courtesy of Drew Friedman. The article is entitled "Over 30,000 Feds Facing Possible FEHB Premium Spike Next Year." Juicy headline. Got our attention, and I think probably will get most people's attention that are under the FEHB benefits system. The meat of the article here, quote, "More than 30,000 federal insurance enrollees may be in for some sticker shock next year if they choose to do nothing during open season. With 8 plan options being discontinued in the Federal Employees Health Benefits Program, participants currently enrolled with those carriers, most of whom are enrolled in plans from the National Association of Letter Carriers, will in some cases face more than 200% spike in premium cost if they accept the auto-enrollment plan option for 2026. There's a lot of scare in that, right?
There is. And I think it's, when you do nothing in the enrollment period, typically what happens is you just roll right into the next period of the same healthcare plan at the same benefit level. And yeah, your premium may increase a little bit. But what Drew is saying here, though, is there's 8 plans that are going away in FEHB. 8 plans. And there's 30,000 people enrolled in those plans right now. And instead of moving from the whatever plan that is to some kind of comparable plan, the government is just going to put you into potentially a much higher level plan with higher premiums and benefits that you don't need. And so this is a call out. I mean, this episode is dropping December 3rd or something like
You
that.
got 5 days.
Like, you got days.
Yeah.
You've got days to get into your plan and check it out and make some changes.
Yeah. So basically, what you're talking about is the fact that they're dropping the National Association of Letter Carriers plans, the high and the basic of those, which captures, I think, the vast majority of these folks. What they're doing, like you said, if you do nothing, where you would have normally kept your original plan, well, the plan isn't there. So the government has to put you in something. They're not going to just drop you from your health. That would be the worst thing, right? Dropping you from health coverage completely. Yes. Well, up until this year, when this happened, from what I'm read in this article, the government would actually move you into a very basic, cheap plan. Okay. And I wonder, about the rage of folks that got caught up in that. Like, how would you feel if you actually needed a lot of, coverage, and all of a sudden you're stuck with this super low premium plan? Okay, sounds good, but the coverage isn't what you need. And then now your deductibles are sky high, including a very high out of pocket. So, in the benevolent way of looking at this is hopefully what the government is doing is just trying to make sure you are covered, at least for what you need. If anything, you're going to be over covered. So what that means is she's talking about the premiums are going up. Yeah, you're going to pay a lot more in premiums if you were on a very basic plan. You might go up 200% and pay a lot more for a high plan. The flip side of that is you're going to get a lot better coverage. Your deductible is going to be lower and your max out of pocket is going to be lower. So it's not all bad news, but it is interesting that they just decided to throw you into this. It's the GEHA high plan. Yeah.
If we explore that silver lining just a little bit more, I mean, if it were me and I was in that plan, I'd be looking at all the benefits of that plan and just going to town. Like, what can I get out of this plan since I'm paying for it anyway?
Yeah, because you can't get out of it. If you're after December 8th and that's it. Now you're in this plan for at least a year till the next enrollment period, unless you have a qualifying life event. Yep. Again, go listen to episode 5. But so if you're stuck in this. Now, getting back to that decision with the government, I would love to see the thought process behind this decision. I'd love to see the email, especially like they're like, hey, we're just going to go with GEHA high plan. Like, okay, how did that work out? Like, is that really the best option? No I always question the quote unquote fiduciary duty of the government, if there is one, and how they came to that decision. But that's for our.
Could be rolling dice. Somebody could have lost a poker game. I don't know.
That's for the conspiracy part of our fiscal foxhole.
Rob, I think the point here is it doesn't take very long to jump into your benefits and just double check. And overall, 30,000 people in FEHB, there's a lot of government workers. So this isn't a huge percentage of government workers. But the point is, even if you're federal or you're a military under TRICARE, it doesn't take that long to just jump into your healthcare plan, see what you're signed up for. Does it still fit? And if it does, great, leave it and just move on with your life or make the changes. It still doesn't take all that long to see what fits for you.
And you're supposed to be doing this anyway. Again, episode 5. This is the whole point we brought this up. Like you said, Omen, 30,000, that's less than 1% of federal employees covered by the FEHB, right? So why are we even talking about this? Because this can happen any year. It can happen next year. The warning still applies to everybody every single year. Go in, check your benefits, make sure it still applies to you. If you had changes in your needs, etc., go ahead and review your plan. Look at the fact that costs might be increasing. Another part of this article, she talked about, like, a lot of the costs are going up quite a bit. So you might be in a high plan, not needed anymore for one reason or another. And then you see that the new premiums are going to go up by quite a bit. Well, you might not need that anymore. You can go to a lower one. Go onto the website, check out plans, compare them. No matter if you're losing your coverage or not, that is always a good idea. And that's why we bring this up. I think that's it. That's pretty much all there is to that. I mean, again, just wanted to bring that up to serve as a warning to you folks. You got 5 more days. Get it done. This episode is brought to you by the Military Financial Advisors Association.
MFAA is a global network of independent, fee-only fiduciary financial advisors who specialize in serving military families.
And we're not just highlighting it. Omen and I are members ourselves, so we know firsthand what they stand for.
That's right. Every member of MFAA is either active duty, a veteran, or a military spouse, so they truly understand the unique financial challenges that come with military life.
Plus, every advisor must hold or be actively pursuing the CFP designation, which is the gold standard in financial planning.
So let's put that together. When you choose an advisor with MFAA, you are getting a professional who won't sell you a product, who knows the military life, and will plan using your hard-earned military benefits.
Whether you're navigating a step out of the military after 4 years, a military retirement, or a transition into a work-optional lifestyle, MFAA advisors speak your language.
Visit militaryfinancialadvisors.org to find an advisor who fits your mission.
MFAA, real advice, real experience.
This advertisement is for informational purposes only and does not constitute financial, legal, or tax advice. All investing involves risk, including the loss of principal. Information and opinions provided within the fiscal foxhole do not necessarily reflect official positions or opinions of the Military Financial Advisors Association or its members. Consult a qualified financial professional before making any financial decisions.
All right, let's move on to the meat of the episode. This is the question, the listener question. I'm really excited to talk about this situation. And it comes to us from Traver. Apologies if I'm saying that wrong, if it's Traver, but we believe it's Traver. So
pretty sure it's Traver.
Guess what, Guy, you are Traver now. So Traver writes to us and he asks, how can, quote, soon to be separating service members better plan for what civilian income they should shoot for to maintain or exceed their current active duty military income when those service members will be losing a lot of tax protections and entitlements? Really thoughtful question, smart look ahead, getting out of the military. Because as I think everyone's already aware, if you're listening to this episode, you're already aware that you're in a different tax treatment than most folks. It's not like going from one civilian employment to another, where in one civilian employment, you earn $80,000 and the other one you earn $85,000. And it's a direct comparison because the taxes are treated normally. There's a lot to consider when you pile on the benefits and the tax treatment of military income.
Yeah, I mean, your BAH alone, no matter what rank you are, accounts for almost a third of your pay. And so it's not taxed. And so like that makes a big difference in the amount of net income you see month to month. And when all of a sudden you lose that, yeah, I mean, there's quite a bit to make up for in the civilian space. And so I love this question because there are so many different layers and considerations here that we can dive into, and we will dive into over the next few minutes, that I think will pique the interest of most, if not all of our listeners.
Yeah. And what's the letter that we got every year in the military that it said, this is what you would be making? What's that letter called again? It's not explanation of benefits. Civilian pay equivalent or something. It's just like this letter that doesn't, that's what that's intended to highlight, is the fact that this is what you would have to make on the civilian side in order to equate what you're making now, right? I don't know what's all involved in that calculation, so I can't really speak to that, but that's the general idea and why the military is trying to show you the tax benefit, the overall benefit of your military service. Now, before we dig in, let's talk about what Traver's really asking here. Now, he's pretty clear what he's asking. He's like, how much money to maintain or exceed current active duty military income? So he's just talking about the income that I assume he means take home, right? Because that's what really is useful to us.
Yeah, before we move on, because it was bothering me, I did have to look it up. It's the personal statement of military compensation.
Oh,
right, so that's the letter.
The PSMC.
Yeah, the PMCMC. Yeah, so that's the letter that everybody gets every year, or it's, you can find it on your military record that says this is the equivalent civilian pay that you would need to get to what you are getting in benefits from the military. So
thank you very much.
Sorry, I had to let that one go.
I appreciate that. That's great.
Yeah, absolutely.
Now, while you were ignoring me and Googling, I was talking about the question that Traver's really asking, because he's pretty clear about it. But I think what he means is like, he's interested in how much money he's going to take home and what does he have to make in the civilian side after he retires in order to equate that amount. But we're not going to just take that at face value because there's a lot to consider, right?
Yeah, Rob. So this is why we are going to dig into this question just a little bit more, is because it requires it. For instance, what is Traver's standard of living, right? He's made a standard of living that is wrapped around his pay. He mentioned that he's an O4 at the moment. So he has a standard of living that is wrapped around what is supported by his O4 pay, BAH, BAS, all of these other incentive pays potentially, and his expenses as well. So like, how does that transfer from the military lifestyle to the civilian lifestyle and what he would have to earn on the outside in order to achieve his current standard of living?
Yeah, that's the question, right? I think in what you said, the expenses, that's where you begin. Because Traver, you need to track those first, right? Make sure you have some tracking software, whether it be your, downloading credit card statements or using a subscription like Monarch or whatever. Start tracking your expenses now, because whatever your lifestyle is between discretionary and mandatory expenses, then you need to kind of look at those and what are you willing to part with? It sounds like you want to keep the same standard of living. So let's just go ahead and track your expenses. Let's get real honest about that, because perhaps you're saving a ton in your TSP. We don't know that, right? So maybe your expenses are already pretty low. So maybe you don't need to take home the exact same amount of money. But since that was your question, that's where we're going to start with. Now, Traver did a little bit of work ahead of time for us, which is really nice. He included a calculator from Charles Schwab, which we were unaware of. We're not endorsing this calculator. In fact, it's our first use of it. We sniffed around and we played around with it. And it looks like it's a pretty decent start to figure it out. I'll include the link to that in the show notes, but it is simply a calculator kind of answering his exact question. But before we dive into those results, let's just talk about first, let's back up. Like, what do we know about Traver? Like, what do we know for sure before we can throw it in a calculator and have a further discussion?
Yeah, absolutely. So Traver told us that he currently pays taxes in Virginia. So meaning he is a Virginia resident. So unbeknownst to him, as a Marine who revisits Virginia all the time anyway, it's like he's paying taxes of his military pay to Virginia. He does not get the tax benefits of some other states where there is either is no income tax or you don't pay the taxes when you aren't living in the state. His plan is to retire, though, in California. So it's a change of residency, a change of tax states there. His other facts here, he'd like to continue receiving money on the 1st and the 15th. So that's an interesting one that we can dig into as well. He is an 04 now. He wants to retire in 2031. He likes me more than Rob. He's a Marine. Yep. He's a Marine. So clearly he is better than all of the rest of the services. We also know that he's married, but for the purposes of our episode here, just to try to keep things a little less complex, we're gonna assume single. All right, we're just going to take a single person doing this. It just takes one layer of complexity out of the equation as we start to go through some of these.
Yeah. There's a little bit of editorializing in there. Want to back up?
I don't think so. I saw it in the email. He likes me better.
I would like you better. If I was listening to this too, I would like it. The thing I want to strike out kind of from the beginning is, sorry, Traver, to be paid on the 1st and 15th. I want to get rid of that. And only because I want to challenge your thought process on that, Traver, because it sounds like that's more of a budgeting concern than it is an actual timing concern. I can't imagine some sort of obstacle that would require you to be paid on the 1st and 15th. This smells like maybe a cash flow issue that maybe if you're worried about when you're going to get paid, then you've got a cash flow problem. All right. So I think you need to back up and maybe tackle this from another side, like some behavior stuff. I don't want to get too much into it, but your take-home pay is the take-home pay. The first thing you need to understand is you're the military retirement, whether it be your pension or potential disabilities, you're getting paid once a month. So I think you need to wrap your head around that first and understand your net take-home pay, whether it be monthly or annually. You need to kind of digest it on a monthly basis.
Yeah, I might challenge you just a little bit on this, Rob. I mean, sometimes it's just people's comfort factor, right? Like, I totally acknowledge that most of the pays that we deal with as retirees are going to be on the 1st of the month, and learning to budget your month, like from month to month. I mean, that works for most everybody. But if you want to be paid on the 1st and 15th, there are tricks that you can do with your pay. Like, if you're going to get paid all on the 1st of the month, you can stack a half of it away in a savings account somewhere and give it back to yourself on the 15th. If that's truly what you care about and what you want to do, like, go for that. But like Rob said, Traver, you're going to get paid your disability pay, you're going to get paid your retirement pension, paid on the 1st of the month. So just getting used to, and you can do this before you even hit retirement, right? You can get a paycheck or 3 ahead and start paying yourself on the 1st, and just get used to what that actually feels like to control your cash flow across 31 days.
I like that we almost disagree here. I like it. We haven't had an opportunity in these episodes to disagree. It's a bummer.
I know.
The only reason
I need to have like an insurance salesman on the podcast. Then we can disagree all the time.
Admittedly, we're going a little long. This is not important, as important as we're making it out to be, but it's just, I would always get annoyed, and I might make a lot of listeners mad. I was annoyed when I show up to the commissary, and I'm like, why is it so busy? Why is everyone here today? Like, this is nuts.
Because it's the first.
The 1st or the 15th. And I would get so annoyed because I am very good at budgeting. I've always been a good budgeter. So to me, like, every day is the same. Like, I don't worry about when cash flow is going in or out. Just make sure that we're in the black at the end of the month, as they say. So anyway, my turn to editorialize there a little bit, but
this is why Traver likes me better.
All right. Now that's what we know about.
What do we not know about Traver?
What do we not know?
Yeah. What do we not know?
Okay. So let's assume he's going to be in 05 when he gets out. He said he's got 6 years left in 2031 retire. Okay. So chances are high that he'll be promoted again to 05 in 2031. He said he's saving into investments, but he's pretty opaque about that. We don't know the tax treatment of those investments or what they were, or if they were tax deferred. I would just assume they were tax deferred. It's kind of the easiest, most standard way to put money away, i.e. TSP. We don't know if he has any income coming off those investments. So if it is a brokerage account and he's got some income producing assets that he's not reinvesting, such as dividends or interest. And also where in California plans to live. And this is important because as we'll kind of get along here, that makes a big difference. State income tax applies to all of California, but standard of living doesn't. Pretty different.
Yeah, absolutely. I mean, I grew up in California. I grew up near Yosemite, and I guarantee that my cost of living in that location is a lot different than Southern California.
Yeah. Well, it helps that
or any coastal city for that.
Yeah, it helps you live. Didn't you live like off grid in a cabin in the woods and killed squirrels for
close? Yeah. Yeah.
Pretty cheap
somewhere. Yep. Right. That's where I learned to wear my tinfoil hat.
All right. So that's what we know. We don't know about Traver. So let's just get into it, shall we? Like I mentioned, he did offer the calculator, and you did some work ahead of time regarding this. You put some of the stuff in, that some of the knowns and unknowns into that calculator. You found some results for him.
I took all the assumptions that we had, and I'm going to make this digestible for the audio format here best I can, right? So I'm not going to spit a whole bunch of numbers at you, but in short, when Traver retires without inflation, this is not inflation adjusted. When he retires as an 05, as a single person with BAH, BAS, and his pay, his net income is $136,000 net. So no tax, those taxes have already been pulled out and everything. So his net income, take home pay, $136,000. So this calculator takes that number and uses that as the income target for civilian pay. So when you put this over onto the civilian side, now all of a sudden you've got a lot more taxes involved to achieve $136,000 of net take-home pay. So the calculator takes his pension into account. So his pension is about $64,000 a year, fully taxable at the federal level. And then it takes a civilian job an additional $161,000 for a total of $225,000 required to achieve a net take-home pay of $136,000. $225,000 to achieve a net take-home of $136,000.
That doesn't feel right. I don't know why. It just feels like an extreme amount of taxation. But he's moving to California.
He is. Yeah. I mean, we could break down those taxes, right? Federally taxed at somewhere around $44,000. But this is where things get weird. State tax is $30,000. And I think that we can break this down. We'll break this down a little bit later on in the show, but $30,000, even for California, seems a little bit rough there. So that's the state taxes. And then, of course, you've got your FICA, your Social Security, Medicare tax as well to get down to $136,000. So these are the base numbers that we're working with when we break this down even further into some considerations as to whether or not this calculator is worth using or not, or if there's some nuances here that we need to take into account when you're looking for a civilian job.
I think that's fair because we have to come up with a starting point, right? Like where are we beginning? And just to highlight the fact you mentioned, this is not inflated 6 years out. So this is if Traver was retiring today in 2025 as an 05 with 20 years in. So if you want to inflate that out, there's ways you can do it. But yeah, let's just mention, we're in the future. This is him retiring today. Okay, so let's break this down a little bit, including some of the things that we already teased that, like I said, it's not too bad, but it does feel a little bit off and also doesn't take into account everything. So let's just talk about the first unknown. And we talked about California and the different parts that there's cost of living issues that he needs to consider.
Oh, yes, absolutely. 100%. Right. Like we made the assumption that Traver is going to retire in one of the most expensive places in California that you can, right? Because everybody loves San Diego. Everybody loves LA-ish. I mean, I don't know about you, Rob, but when everybody says, I'm going to California, you said, where in California are you going? LA. I'm like, okay, cool. Great. Just coming from a guy that came from the woods, like there's some nicer places in California. But anyway, let's stay on target here. LA, according to bestplaces.com, is about 13.6% overall more expensive than Fairfax County and Virginia. Hard to believe. The housing, I know, right? Because we know people in Fairfax County. So housing costs in LA are about 35% more than in Fairfax County. Virginia.
Even harder to believe.
And we chose Fairfax because it's, well, I mean, we chose Fairfax, honestly, because that's kind of a split in the middle between a Pentagon work and maybe somewhere in Quantico or something like that. I don't know where he lived, but ultimately, these are some costs of living that you're going to have to take into account as part of this calculator, that maybe that $136,000 net take home pay isn't quite going to be enough.
That's a great point. No matter where you go, LA, California, wherever you end up, any other state you retire, this is number one on your list to just to check off, because your net is not going to go as far, or it's going to be a lot more than you need, depending on the lifestyle that you desire.
Yeah. And I don't want to scare anybody up from going to live somewhere where they want to live. Traver specifically said he wanted to live there because it would put him close to family. So 100% endorse, go for that and do that thing. And just know that if you go and live in a place like that there might be some higher cost of living. It could work out for the better the other way too. But in this case, it sounds like it's going to be a little bit higher cost. Yeah.
Now, Traver also failed to mention anything about expected VA disability, which is okay because, as we talked about in previous episodes, you model your clients as zero, as nothing. And sometimes I add in just a reasonable expectation, maybe 50% or whatever. But so we don't know about VA disability. So if VA disability comes in, well, man, that's a huge chunk. That almost brings a BAH back into play, almost that same level of income, not to mention the healthcare benefits, right? There's a lot to that. That's a game-changing amount potentially for Traver to consider. And that's one you're just going to have to play with different ratings and figure out how it affects. The nice thing is it's just a straight subtraction. If you need 136,000
yes, and
you get the VA disability, and your VA disability is going to provide you $22,000 of income, straight subtraction right off the top. That's assuming you get 50% or higher, right?
Yeah, I took your route with this, Rob, and just assumed 100% and then a 50%. But with that 100%, if he were to retire today, that's $47,000 that he can now just take off the top of that net pay, and he only needs an $85,000 job. I mean, that's huge, right? Well, the difference in that kind of a job, he might actually be bored at work with an $85,000 job. That's probably not a very engaging work. I don't know. But yeah, it's a big deal, particularly if you are over that 50% threshold, right? We had our episode with Heather that said over 50% threshold. That is a big deal because now you're getting all of your pension, plus you're getting a separate check from the VA.
In my defense, I don't assume 100%. I don't assume 100% for anybody. I do assume, I know what you mean. I assume some VA disability, or play with it, just give an idea. Because if you get this, it changes things dramatically. It's just so much. It's such a huge benefit.
Yeah, sorry, I didn't mean you always just give everybody 100%. But no, I know you have several different scenarios laid out just to kind of see what it might look like.
All my clients' plans look fantastic. They're all getting 100% VA. They're all success. They're going to be great. Yeah. All right. Okay. So we did talk about the difference in states, but our next point is it doesn't account for the potential state tax benefits. And you mentioned that a lot of states don't tax income at all. We're not talking about that. We're talking about your actual military pension. States tax those very differently, including Virginia and California. Those are great examples to bring up. I'm glad he's moving from Virginia to California because they're great. Virginia is one of the best ones, and California just adopted some relief for military retirees.
New for this year, 2025, $20,000 subtraction from your state tax benefits. So, Traver, this isn't just for you. This is for anybody listening that is either retired in California, planning to retire in California. There are some rules here. There's a cliff, basically at 125,000 AGI for single or 250,000 for married couples AGI. That if you go above those thresholds, then you lose that $20,000 subtraction. And so while we'd sit here and tell you, don't plan around tax benefits, but if you're close, like if you're a couple $100 away, $1,000 away, maybe give a little extra to charity, or I don't know, itemize something to try to get you under that threshold. But yeah, each state has its own way of taxing pensions.
I like that you added that in, because don't let the state tax wag the dog here. I mean, people make a lot out of state taxes, and they should, because they're real and they matter, especially if you're going from tax-free state to somewhere like California. But we're talking about a $20,000, exclusion from his taxable pension. For California, this could be about $2,000 a year. It's not nothing, but also it's not going to really change. It's not going to, not going to take a different job based on $2,000 difference. It's just something to consider. Virginia is a little bit better, but their tax rates are lower. Virginia takes $40,000, but the tax rates are much lower. So the net effect's like, it's about the same amount of savings, right? You did point out the fact that the Schwab calculator estimated his California tax rate at 13.5%. That's the highest amount. I don't think there's any, unless he has some sort of insane tech job, he's not going to be facing that. He's not going to have an income problem if he's paying 13.5%, right?
Not at all. Yeah, that was one of the weird things I saw in this calculator, is that high rate of 13.5%, where actually the more appropriate rate for this income range is 9.3% for California. So, I point that out as something that the calculator did wrong. I don't know what's going on in the back end of the calculator. So it just begs the question, what else might it be calculating incorrectly? The rest of this seems like fairly straightforward math. But yeah, for the federal taxes, I did plug this actually into a matching Dinkytown calculator, and the federal taxes came out relatively similar. So I was pleasantly surprised with that. But yeah, the state tax was interesting.
Yeah. I think the greater thing is what you talked about before, where it's the cost of living is much greater concern than the actual state income tax, I believe. I love the fact, by the way, that we're just giving Traver a whole bunch of more work. We're giving him like no answers. This is the longest "it depends," quote unquote, "it depends" answer that I think I've ever given. We're like, hey, you thought you were worried before? Here's an answer. No, here's a whole bunch of other questions now that you have to deal with.
That's right.
Anyway, but I mean, it is something that you can consider. Now, I just go back to Charles Schwab, we think is pretty good because it's more of the conservative end, I think. Like, it actually is going to tell you need a higher income. But there are a lot of things, obviously that we need to talk about. All right. Remember, we talked about, like, what is he asking? He's asking about, like, keeping the same amount of income. But maybe, Traver, maybe your question doesn't need to be that. Maybe that's a really comfortable idea because that equates to the same standard of living. However, maybe spend time right now, again, like I said, track your expenses. What do you really need? I mean, you might not need to keep the same amount of income in retirement. There's some unknowns and some differences that you might need a different type of income, might be lower, might be higher.
This is the part that I love being a planner for, right? Because in the military, you get a paycheck. It's the same paycheck year over year. You get some inflation, you get a promotion every once in a while. But generally speaking, your standard of living it just goes to your paycheck level, right? Like if your paycheck goes up, so does your standard of living. Now, you might also be saving somewhere in there as well, and I'd encourage you to do that. But ultimately, you are planning to the income level that you're getting. When you retire, it's the first opportunity that you ever get to question, do I even need this amount of income? Right. What do I want to do? What does my family want to do? What's important to me? And what kind of income is required on top of the pension, on top of the disability of whatever benefits you might get, what kind of income is actually required to live the lifestyle that I need to live for the rest of my life? Noting that pension and disability continues for the rest of your life, and then survivor benefit plan and a few other things with disability that we talked about earlier that can potentially continue for the rest of your spouse's
That's
life.
a great encapsulation of the question because, like I said, begin with your expenses, know what you're paying now, actually paying for food, groceries, etc. Look at the state you're going to, cost of living, groceries, housing, etc. Estimate the best you can. Start there and envision the life that you want to live in retirement. And if it includes those other things, maybe you're adding on vacations, maybe you're adding skiing trips on or whatever, like throw that on as well. But you need to start to kind of like play with that number. It's not as simple as just keeping the same income that you have now. It's nice because it feels good for a long time in the military. But like you said, you need to start where you're at and then start envisioning where you need to go. There's some wrinkles here that also Traver needs to consider because it might change the need up or down a little bit. The first one you hinted at is the retirement savings. Because so we know what the pension's probably going to be. We don't know what the VA disability is going to be. That could be game changing. He might get to his retirement and get a VA disability he was not expecting. And therefore his retirement savings, he might be overfunded. So Traver might have been putting $800 to $1,200 away in his TSP a month or more. And then realize once he gets there that the VA disability and the pension on top of, the income he's expecting or whatever, he might not have to put money away so aggressively in a retirement account, 401k on his next job or whatever. Right. So that might be, you might like, hey, I might start saving in a savings account or a brokerage account for other shorter term goals. My retirement's taken care of because I got 80% disability and I wasn't expecting it. That might be a game changer. You might not be needing as much to save. So that would be a takeaway. You would be taking that off the need for your income. You don't need to make as much. Other takeaways, your commuting costs. Like, I don't know, you're going to work from home. You're not going to be driving on to base anymore. Okay, yeah, same, right? Your transportation costs are going to be lower. Probably saving on haircuts. Omen, you're
That's
saving
right.
on razors now, right?
Definitely saving on razors and haircuts.
Yeah, I mean that's probably not worth considering, but you can think about those things, that types of stuff that applies to your current military job that might not apply to your next one. The other things you might want to add on though, however, there might be some costs you're not considering. You might need, professional clothes and buy them every other year or whatever. You're not wearing the same thing to work every day. Healthcare premiums are become a real thing, right? We just talked about.
Can I stop you real quick? The clothes closet is a real thing. I took for granted wearing camis every single day and having a couple of different uniforms that were laid out on the rare occasion that I had to wear them. Having to choose my clothes every single day, load up my closet with some somewhat at least professional looking attire that I can wear every day. Those are choices that I wish I did not have to make.
And add on to the fact that like what happened to me was someone went in and they hemmed all my pants and shorts. The waistline, they brought it in like 1.5 inches as soon as I was getting out of the Army. It was wild. So now I have to go buy. All right, add on healthcare premium. You might have to add a healthcare premiums. You haven't had to pay healthcare premiums. Now you might need to pay some sort of healthcare premiums. Continued life insurance. You're losing $400,000-$500,000 in term life insurance. You might need maybe in the immediate future for the next 10 to 15 years. You're going to have to pay out of pocket for that. Healthcare deductibles you have to pay for. And then loss of any other active duty cost benefit. I mean, those are really intangible, right? The personal statement of military compensation somewhat, I think, tries to capture some of that, but really anything else that you're getting some sort of, military benefit, cost benefit, you're probably going to have to add back on to what you need.
Yeah. So, I mean, the bottom line out of this particular takeaway is that there are some elements that could reduce your income need. There's also some elements that could increase it, but we're trying to give you some of these considerations up front so that you can start to put these into your calculation as you approach retirement. The last thing I would leave you with out of all of this, it's okay to rehearse it. And what I mean by that is you don't have to wait until your 20-year mark to then try out what retirement feels like. You can actually start to set this stuff up in a way where you could live like you are retired month to month on this income and decide, do I like this? Do I not like this? Do I want more income? Do I need less income? You can actually have a dress rehearsal for this ahead of your 20-year mark. So I would encourage you to do that as you start to approach that time.
That's brilliant. Just don't go AWOL. Don't go full retire. It's a financial dry run. It is not a physical one.
Practice.
All right.
That's right.
Hey, you're welcome, Traver. I think we answered your question. Crystal, you should have no more questions after this. Like, that is crystal clear.
That's right.
Aside from all the other questions now that we've planted, you're like, oh, now I've given you a ton more work. But reach out. I mean, we can help you. We'd love to work with you and talk to you about your situation. Maybe give you a little bit of more in-depth analysis. I know I do with prospects. I don't want to speak for you, Omen, but feel free to reach out. So as we wrap this up and move on to our game time and the off duty that I'm looking forward to, just know that it's really hard. It's a great question because you don't know. You're never going to know, but you can estimate for almost everything. Think about the tax situation. That's the biggest one. Know your expenses. I think that's the next biggest one. I think you should know that anyway. And then use calculators like the one you brought to us, Traver. Awesome. You brought up the Dinkytown one. That's great. Just play with it. And I think that's really nice what you just said about like the dry run. Like, just kind of play with it and practice if you need to.
Yeah. And these calculators, like, I'm not going to down this Schwab calculator. I think, Traver, it got you into a general vicinity of what's realistic. But as you pointed out in your question, there's a lot of nuances to every situation getting out of the military that changes the calculus, the inputs of the calculator itself. So in general, I think you're getting into the right position here. But yeah, there's quite a few other considerations. So thank you, Traver, for sending in your question. Rob, what is Traver going to get for his question?
Traver is the first recipient of the official I've Been in the Foxhole Elite Listener Status Unlocked t-shirt. I love it. Wait, does a t-shirt actually say Elite Listener Status? Oh,
yes.
That's awesome.
It does.
I love it. Great.
Elite.
Yeah. So you'll receive a t-shirt. We'll be in touch with you, or if you're listening, send us an email with your size. We'll get you squared away, an address where to send that t-shirt. But for future,
let me emphasize, these shirts are only available for listeners that send in their questions that we actually put onto the show, and Rob's mom.
She's a big fan. I can't wait for the email from that one. All right. I think we did it. You're welcome, Traver, once again, and look forward to seeing you in your t-shirt. If you think about it, man, take a picture, send it to us. We'd love to see you in your new swag. But now we are getting long here. That's a lot of fun talking about that stuff, but it is time to get into our game segment. This is our never-ending trivia challenge between the two of us for prize of pride and pride alone. Current score is Rob with 0 and Omen with 1, with a commanding lead. This is the time in each episode where we trade off asking each other trivia related to our topic. So today I am up to bat. I'm going to see if I can get off the my slump here of 0, or if I can continue my. I don't think so. I'm not confident in myself at all. But Omen, you are up to ask the question. What you got?
All right, man. So unlike the question you gave me a few weeks ago, or maybe it was last week, I don't know, whatever question that was not even a question. It was a 20-minute statement of some facts that you couldn't pronounce. This one's easy for
Fantastic.
you. Here we go. Which major U.S. city consistently ranks among the places where BAH, for many ranks, fails to cover the median rent, making the civilian cost of living jump even harsher for separating service members? Is it Honolulu, Washington, D.C., San Diego, or Seattle?
Man, because it's not as simple as what's the highest standard of living. That would be a lot easier. Now I have to try to figure out what the kind of the delta rate between the BAH and standard of living.
I'm trying to keep you at 0.
Okay. Well, you're doing a good job. So the only thing I can say is between, you said what, San Diego, Seattle, and DC, and Honolulu, right? Okay. I don't know this for sure, but I would imagine Honolulu has the least amount of data, maybe to support the research of what BAH should pay for. In other words, it's probably the least populated That's just a guess, right? Out of those 4 cities. So, absent any other knowledge except knowing the fact that all 4 of those are very high cost of living areas, I'm going to guess Honolulu.
Wow, Rob, you're still wrong.
Yes. Yes. Fantastic. I'll take my logic and my 0 and I'm going home.
So Traver's actually going to love this one because it's San Diego.
Oh, okay. That's interesting. Yeah.
Yeah.
I wonder why that is. So is it just BAH just doesn't cover what the standard of living is there?
Yeah. The cost of living. Yeah.
That's wild. Well, I am wrong.
Yep.
We are now 1-0 yet again for the remainder of the year. Are we resetting this at the new year, by the way? Or was this like,
I think we should. Yeah, we should.
Otherwise, we're going to be like 6 years into this, and the score is going to be like 4-3.
What's my trophy? That's the only thing. What's my
t-shirt.
trophy?
We already know this, right? Yeah.
Yeah. Oh, okay. I get my own t-shirt.
Yeah.
Sweet.
Well, hey, good. I'm glad. That's such a relief. Get that. I'm still 0. I love it. But that's going to wrap it up for today's episode of the Fiscal Foxhole. We hope you took away some great information that you could use in your life and you know forecasting out your retirement scenario. We certainly hope we helped out Traver in his situation. We know we gave you a lot more information than you're probably asking for, and definitely gave you a lot more questions to consider. But we thank you for reaching out and giving us a lot of meat to chew on, and talk about these financial considerations for military members. So, Omen, before we leave, what are our takeaways from today?
Our key takeaway number 1, if you're a federal employee and your FEHB plan gets discontinued and you don't take action, you could get auto-enrolled into a plan that costs way more, in some cases over 200% more. With open season ending December 8th, everyone, not just federal employees, everyone, take a few minutes to check your plan so you don't get ambushed by the government. Our key takeaway number 2, online calculators can get you in the ballpark, but they miss big variables like state taxes, VA disability, and regional cost of living. To aim for the right civilian salary, you've got to plug in your real assumption, understand your true standard of living, and sanity check the results with better tools. And key takeaway number 3, if you ever feel goofy about mixing up financial jargon, don't. I'm out here saying withholdings like it's Pokemon, and Rob's touting the benefits of tax loss harvesting. The real lesson? If we're allowed to butcher the terminology and still talk money, so are you.
We'd love to hear from you. If you have questions you'd like answered on the show, please send us a note to fiscalfoxhole@gmail.com. If you heard something today that you'd like to discuss further, or you just want to dig deeper into your own financial game plan, both Rob and Omen are accepting new clients and always happy to chat. You'll find the links to their websites or to book appointments in the show notes. Rob Moore and Omen Quelvog are both registered investment advisor representatives. This podcast is for educational and entertainment purposes only. While they are both advisors, they are not your advisors. Therefore, nothing you hear on Fiscal Foxhole should be taken as specific investment, legal, or tax advice. For guidance tailored to your situation, please consult a qualified professional who understands your individual circumstances.
Omen, my tail is wagging. We're going to talk about Christmas movies now. I'm such an addict when it comes to all things Christmas. I love it so much. I love the whole season, the music, all the decorations. My wife blows out all the decorations. It's great. But a big part of it is Christmas movies. Yeah.
When does Mariah Carey start singing in your house?
It's pretty early. Like we do celebrate Thanksgiving, but we go all in November 1st, right after Halloween. We just go ahead and decorate and kind of embrace it. We don't really go like into the Christmas movie season until a little bit later, because even though there are a lot, which we're going to talk about a few here, but yeah, we kind of push the movies off a little bit. What about you?
Yeah, I think we're doing the same thing. We will start before. In fact, our house is decorated for Christmas right now. I've not put the lights on the outside yet, but the inside is definitely there. I had a good friend of mine. He said that he usually decorates his house for Christmas when the Cowboys become ineligible for the Super Bowl or any playoff games. I said, so do you start decorating in September or what? So,
well, while we were decorating our homes, Omen and I came up with our top 5 Christmas movies, our personal top 5. This is the definitive list of Christmas movies, and we included an overrated one. And I can't wait to get into this. So we're just going to go back and forth real quick, talk about our top 5, and maybe a little something and what it means to us. And did you say I'm going first? Am I going or are you going?
Yeah.
All right, are we doing
go
snake?
First.
Okay.
Yeah.
All right,
snake draft.
All right. So start with number 5. I'm going to go number 5 down to number 1. We're going to slide the overrated in right before number 1. But for my number 5, I'm just going to put a classic right out front here, Christmas Story. I love it. It's a must watch multiple times every year. It is basically comfort food viewing. It's just a great story. It's just awesome, like the essence of like childhood and family and wanting something for Christmas. I love it.
Wish we had video in this.
Why?
People see my facial expression.
Okay.
Let's go. I'm going to give my number 5. My number 5 is Home Alone. And it's actually for that same reason. It's just one of those childhood Christmas films that we have to put on every year. It's classic. Like it just, nothing says Christmas like Home Alone.
Well put. Well put. You're up next.
Next one's one of the more newer ones, I should say. Arthur Christmas. Arthur Christmas. Have you seen this one?
What's his name?
Arthur
yeah,
Christmas.
no, the actor. What's his name? Am I thinking of the right movie?
This one's animated.
Oh, no, I'm not. I'm
probably
thinking
not.
of, oh, shoot. I'll have to think of the name. Anyway, yeah, go ahead. Arthur Christmas. No, I'm unfamiliar with it.
Yeah. So this is Arthur Christmas speaks to the generations of Santa. And the newest Santa is more technologically advanced, or I should say the newest wannabe Santa is the one that is technologically advanced. And so it's just a really cool, heartwarming story of a Santa who should be Santa and one who should definitely not be Santa. So
we're gonna have to throw that on the list. I have not seen that one before, so we'll throw that on. Yeah, okay. Great. Assuming it's family friendly, right?
It is definitely.
Okay, good. All right, my number 4 is Holiday Inn, and I put this on the list because it was my favorite. Yeah, it's from it might be the late 30s, early 40s. It's a classic. It's all black and white movie. Yeah, Fred Astaire and Bing Crosby, like classic Christmas movie. It's really great. Now, I won't say it's like a really wonderful, like awesome movie. But it was my mom's favorite. And it kind of brings me comfort. I remember as a kid seeing scenes of it, and I remember these scenes. And now as I get older, I grow more. I have a much higher appreciation for these older films, like White Christmas, Holiday Inn, Miracle on 34th Street, etc. So I throw those on every year and watch them, and it makes me happy. All right, going more current for number 3 is Scrooged with Bill Murray. It's our family's favorite. This is kind of one of the first ones we watch, I think, for everybody. I'll watch anything with Bill Murray in it, first of all, okay? And also this is just, the timeless Christmas Carol story. It's one of the greatest stories ever written. I love it. I'll watch almost any adaptation of it, but this is my favorite. My funny thing about Bill Murray is, like I said, I'll watch anything. Anything he does to me is funny. And it reminds me of a scene. Have you seen Zombieland? Okay.
No.
I'm going a little bit deeper on this than I intended to. I apologize. There's a scene in Zombieland. He plays a cameo where he's actually a healthy person. He's not a zombie. And he ends up getting killed, like in the movie shortly after. And he's playing himself. He's playing Bill Murray. And as he dies, he kind of exhales and dies. And Emma Stone, who's in the movie, she giggles. And they look at her like, what the heck? And she's like, I'm sorry. He's just funny. Like him dying even was hysterical. I can relate to that. I love it. And for that reason, I love Scrooged. Watch it every year.
Let's see. My number 3 is Polar Express. I like this movie. Yeah, this is one that grew up with the boys watching. Megan doesn't actually like it all that much. I don't know why, but this is definitely one of my favorites. I enjoy the story, the adventure, and basically trying to keep Christmas alive as long as humanly possible.
Yeah,
so.
We watch that every Christmas Eve. Ever since Mary was a baby, we watched it. Yep.
Oh, really?
Christmas Eve, we watch that. Yeah, it's a big one for us. Yeah.
Nice.
All right.
Yeah.
Number 2,
cool.
what you got?
All right. Number 2, White Christmas.
Oh, yeah.
So this one, all 4 of us as a family, we watch every single year. We love this movie. In fact, even with Gabe gone out of the house now, we will actually set up a viewing party with the four of us, and we'll watch this at Christmas, the four of us still, even though that we're in different places, different locations. So this is just one of those, again, feel good, old classic movies we just love watching together.
That's great. Number 2 for me. And then I'll do number 2, and then we'll do the overrated, and I'll throw it back to you. Okay.
Yeah.
All right. Number 2 for me, Christmas Vacation. Just, it's fun, wire to wire. There's no dead time. Like, it's just great. You could pop into this movie at any point and enjoy it. Every scene has something. The reason why I put this so high, though, aside from how much fun it is I believe it really captures the essence of being a father with a family around the holidays. and I don't mean like all the
That's why Tylenol.
Like falling off the ladder and all that stuff. I don't mean that. I mean just his desire to have his family close to him, really. And also the stress of making sure he's providing, the Christmas that he's, this dream that he has to provide for his family, because it's all family centric. So in the heart of this really fun, hilarious movie, there's a really like warm message and a really something that I connect with every single year. Cause this is something like, as my kids get older, like I just want to have a big family Christmas and have everyone together. And I can really relate to that.
Yeah.
All right.
Yeah. Hey, Griswold, where are you going to put a tree that big?
It's great. Such a great one. All right. Skipping.
All right.
Yeah.
Overrated.
Okay. Before we hit number 1, overrated. Omen, you're going to hate this. And I imagine a lot of people are going to write in, and I hope they do. But I'm going to dive in here a little bit. The most overrated Christmas movie of all time is Home Alone. It's not even close. Okay, look. Okay, I like the movie. We watch it. I watch it every year. This just despicable characters, all of them. Like from the jump, from the very first scene, the family's awful. Everyone in the family is awful. The uncle is a cartoon beyond imagination. He's a caricature of a terrible person. The uncle, like no one exists like that. God, I hope not. Buzz is a monster. A complete unhinged monster, and it's the parents' fault. The parents are terrible. The rest of the kids suck. Kevin, the protagonist, is the worst of them all. Can't stand him. Like, he's the protagonist. You're supposed to like him. I can't stand watching that twerp with all of the knucklehead things he says and does to his parents. That, I mean, in some households, he might not survive in without being punished physically for that. That's all I'll say. Mom is completely obtuse to everything. Dad is passive, like not active in any way in participating in anything. Here's the twist I'll give you. The only likable character in the beginning of the movie is Joe Pesci. Like, what were they thinking? It's ridiculous. I'm coming to the movie and I'm supposed to like Kevin, and I'm supposed to be like sympathetic to the family. I don't like any of them. The only charming character at the beginning of the movie is the antagonist, is the criminal, is Joe Pesci. And on top of that, they throw in, for good measure, the pizza guy who deserves nothing that he receives. He's ignored while he stands there, right? Okay. Finally, he does get a tip. Okay. But, and then he doesn't deserve the torture that Kevin puts him through, like in the movie. Right. Yep. And all that aside, the acting drives me crazy. And I know they're kids. It's supposed to be, fun or whatever. It's just so bad. I still watch it. I enjoy it, but it is definitely the most overrated Christmas. I yield my time back to the segment, and I'll give you your time to talk about overrated, which I think is coming back at me.
Yeah, it's funny that you say this because we literally had no communication about this beforehand, and somehow, some way, out of the 100 Christmas movies that we could absolutely choose from, somehow A Christmas Story on your list wound up as my overrated.
Let me have it. Fair enough.
How does this happen?
I get it. I've heard this before, but yeah, go ahead. Let me have it.
The story itself is fine. It's fine. Like, I get it. But again, the family dynamics kind of drive me crazy in that particular movie. But I think for the most part, where people find it endearing that it plays for 24 hours on Christmas Day on TBS every single year, like that drives me crazy. And so I just have this memory of A Christmas Story over and over again of Ralphie, you'll shoot your eye out. Just like on
Yeah.
and on. So, yeah, overrated.
Overrated, overdone. I'll give you that. Yeah, it's definitely
Overdone.
on too much for sure. It's a good movie. I like it, but yeah, it's in your defense, it's overdone and on too much. Yeah. Okay, on to good
right.
things. Number
I
one.
guess number
Go for
one.
it. Mhm.
My number one, I think you'll be pleasantly surprised, is National Lampoon's Christmas Vacation.
Yeah.
Yeah, I had to put it up at number one. So I love that movie. And I got the boys hooked on some of the lines from there. And and my whole family, we speak in movie quotes. Me, much less. But I think the rest of the family, they speak in movie quotes. So around Christmas time, it is the Christmas Vacation movie quotes all the time.
Defense, yeah, in your defense, yeah, that's the movie we watch, I think, first every year. It comes up first in our rotations. One of the first easy ones that, like, just any of the other ones you could drop in at any time and just enjoy it, like I said, and very quotable. I like that. Yeah. For my number one, I'm gonna go. You're gonna be surprised. It's not. You would never guess it, but it's becoming one of our. It was just released in 2021, and it's become our family's favorite Christmas movie. And that is 8-Bit Christmas. Have you seen this?
Not.
A lot of people have not. Yeah,
8-Bit
a lot of people
Christmas.
haven't seen it. It started out as I think it was on Netflix, released it, or it might have been Apple. I don't remember, but it's available now. You can get it anywhere. Do me a favor and watch it. It is really wonderful.
Okay.
If you enjoyed Christmas Story for like the family and the wholesomeness and everything of it, you'll like this movie. It's just a tremendously good story. At the heart of any good movie is a good story. This has got a wonderful story buried in. The main plot device is it's set in the 1980s and it's about kids trying to get a Nintendo for Christmas. All right. It
Nice.
captures everything about that, about Christmas time, similar to A Christmas Story, about a kid that wants something for Christmas, right? It's hilarious. It's engaging. It's the fun plot that kind of keeps you engaged throughout the whole thing. It's directed well and acted well. It's pretty tight. There's not a lot of dead space. There's some stuff kind of near the middle end that could be chopped out, but it keeps me in the whole time. But here's the thing, that the reason why I really love it, and I don't want to spoil it for you, but it captures the idea of legacy and the idea that Christmas is stewarded mostly by parents, right? It's about the religious birth of Jesus, etc. But when we talk about how it affects us as families, the parents are the steward of Christmas, like that, kind of giving it to their children and showing them what it's all about. This movie nails it. It really does a good job.
Okay.
Yeah. So I can't say enough good things about 8-Bit Christmas. I think you'll really like it. And for us, like I said, for those reasons and like the really like the pulp fun in this movie, in addition to the great story and then the great message in it, for me, it moved it all the way to number one. It's our family's new favorite.
Okay. Yeah, we will add it to the list this year.
That
for sure.
and Christmas Story, right? You'll watch those back to back.
Oh, of course. Of course.
And we've already watched Home Alone. We were down visiting the mouse last week down in Florida. We did have Disney Plus on. We watched Home Alone 2. Of course, we're going to watch them. It is overrated, but I'm not a monster. I'll watch them.